Good morning and welcome to West Michigan Philanthropy. I am Jon McFarland with Miller Johnson, and I'm joined today by a former colleague at Miller Johnson and friend, Jon Beer. Jon is an attorney with Levun, Goodman Cohen in Northbrook, Illinois, is where their office is based, but Jon is based in Grand Rapids here and works for his firm and handles matters in Michigan and Illinois. Jon's got a background in with Anderson Consulting, worked with Miller Johnson for years. He's with Levun, Goodman and Cohen now. LLM in tax from Northwestern University. It's a tremendous experience and background there. Jon's practice is focused in estate planning, tax matters, corporate work, does a lot of work. And I think, Jon, your firm is known for its area of expertise being partnership tax, pass-through entities, a lot of thorny accounting and tax issues that you all are experts in handling for clients. So welcome, Jon. That's great to have you here this morning.
Yeah, thanks, Jon. You're going to introduce yourself like that too, or you?
Well, so today we are going to talk about a case that from the tax court that was a recent case, and it's been talked about quite a bit here, the Hoensheid case. And what we have in the Hoensheid case is there was a family-owned business, and the company is called CSTC. That stands for Commercial Steel Treating. Started by Ralph Hoensheid in 1927, and Ralph's grandchildren were all one-third owners now in that company. And so there are three brothers, and one of the brothers announced that he wanted to retire, and that prompted the other two brothers to think about the sale of the company. Petitioner in this case, I believe it was Scott Hoensheid, wanted to make a gift of some of his shares in anticipation of a sale. And he worked with Fidelity Charitable. So on April 23rd, 2015, the parties executed a non-binding letter of intent for the purchase to acquire the corporation for $107 million. So that was quite a substantial amount there in play. The emails in this case, Jon, were something else. And so that's, as I read this, I thought, my goodness, these were some pretty bad emails to have out there. And you can imagine probably everybody was copied on these emails. I thought of privilege issues as I went through this, but the one problem here is the petitioner taxpayer stated that in an email to his advisors, I do not want to transfer the stock until we are 99% sure we are closing. So what he didn't want to do here, he has equal ownership with his brothers. And I think his concern was, okay, if this deal doesn't go through and I gift these shares to a donor advised fund with Fidelity, my brothers will end up owning more shares than I do, and I don't want that to happen. So you see this control element with a lot of taxpayers. They want to control every aspect of a transaction. And that really, I think, was the downfall here, Jon, with the taxpayer, that control element, these emails suggesting that he wanted to wait until the last minute. We see there's a litany of cases in this area dealing with the anticipatory assignment of income, prearranged sales, ripe and gained, the Palmer case, the Ferguson case, the Rauenhorst case, the Dickinson case. There's quite a bit there. This adds to that body of law. And really where the taxpayer got in trouble was with that anticipatory assignment of income. Basically, if you look at it, the service doesn't want a taxpayer to, in essence, do a little bit of a shuffle pass to charity right before the sale to bypass gain. They want it to be a legitimate, irrevocable surrender of title, dominion, and control of that asset as a gift. And then the transaction is to follow. Now, the timing is key here. And it was clear by the fact pattern, and the court does a good job laying this out, that it was a virtual certainty that this deal was going to go through by the time the gift actually took place. There was a dispute about what was the actual gift date. I think that the petitioner argued it was June 11th. The tax court ultimately decided it was July 13th, I think.
Pretty, yeah.
The whole month passed, and then there was that actually impacted the valuation a little bit, the deduction. They actually took a larger deduction than was actually the amount received by Fidelity Charitable and the Donor Advised Fund. A lot of bad facts here that really made it a problem for the taxpayer. I think, you know, John, as we have talked about, the appraisal was a big issue. They did not adhere to the qualified appraisal requirements. One, we had mentioned on the gift, the date of that gift, they were off with that. They said June 11th. It was actually July 13th.
Yeah, I think it was, might have been July 9.
July 9, there was a series of facts where I think July 9, the stock certificate was held by the petitioner for some time in his office, in his desk. And then he had his attorney have the power to then make that gift to Fidelity Charitable, and that wasn't done till sometime later. I think the court ultimately had ruled that the 13th was the date that Fidelity Charitable received the stock certificate. Oh yeah, okay. So, but part of the problem is that qualified appraisal in this case was not qualified. The appraisal was not qualified. It didn't state that it was prepared for federal income tax purposes. The court ruled that the appraiser really wasn't qualified. I think that there's some testimony there where the gentleman who appraised the shares, the company, really hadn't done a qualified appraisal before for federal charitable income tax purposes. And so there were a series of problems with it. The valuation method was another problem that the court pointed to. But that really, the anticipatory assignment of income issue and the qualified appraisal failure to comply with those regulations is really what sunk the taxpayer here. And we see this with clients, John. And in this case, we saw the taxpayer didn't want to pay for a qualified appraisal. And
who does? But
well, that's true. They can be expensive. But they could run you. I've seen them. Well, they can be expensive. We'll say that.
They can be very expensive, but we'll talk more about it as we'll get to that point. You got to pay for them.
Yeah. And
Cliff Notes version, you got to pay for them.
Yeah, I think that what was an issue here, they engaged a company to really serve as the advisor for purposes of the sale transaction. And there's a discussion in the case about that fee and what was charged, but there was no separate charge for a qualified appraisal in that engagement letter with that company. And the court looked at that, and the taxpayer actually did explore the idea of engaging a CPA firm to perform that qualified appraisal, and decided not to do that because he didn't want to pay for it. And that was spelled out in the case. And that really ultimately was not a good decision by the taxpayer here, because it cost him that charitable income tax deduction. The court said there was a valid gift here. It was just the anticipatory assignment of income issue was a problem, which caused the recognition and realization of the gain. The qualified appraisal issue is what really blew the charitable deduction for the taxpayer. But if you look at this fact pattern, so we had mentioned on April 2015, they have the letter of intent. June 1st, 2015, the petitioner's counsel said a letter of understanding of the plan to donate the stock to Fidelity Charitable.
Yeah.
But a plan isn't going to do it. And the court addresses the delivery rules and looks at Michigan law, and what constitutes delivery, what constitute a valid gift under Michigan law. And, you know, the plan or the intent wasn't a present intent if you send that letter of understanding. It's got to be an actual, the timing is key there.
Right. There was not even a mention of how many shares it was going to be. Right.
There were the facts. Yeah, the facts spelled that out. No mention of the amount of the shares. And up until the final moments, they really didn't plug in the number of shares. I think it ended up being around 1,300 shares, something like that.
Yeah.
But they really didn't have that spelled out until the very end. Again, another fact problem for the taxpayer here. On June 11th, 2015, they held a shareholders meeting where they voted and ratified the sale of all the outstanding stock of the corporation.
Right.
And at that shareholders meeting, they also approved the request to transfer a portion of the shares to Fidelity Charitable. So there, as an advisor, you can see the problem here, you know, and traditionally there's kind of a, you know, conservative counsel would say, get it done well in advance of any letter of intent or discussion or whatever. You know, then if you don't do that, well, you definitely want to get the gift done before there's a shareholder vote or a director's vote on the sale. That wasn't done here. So they've approved the sale, and they approved the petitioner's request to donate a portion to Fidelity Charitable prior to the sale. But the delivery of that certificate didn't take place until, I think you mentioned, maybe July 9th or something like that, the actual physical delivery, or 13th. So
Right. I checked up there. July 9th was the signing date, the day they signed the certificate. They delivered it on the 13th.
And it was a PDF email version, which, you know, to me, I like to see that physical delivery, give them the certificate, you know, get a receipt. You know, the court did talk about a contemporaneous written acknowledgement, and I believe they did rule that there was a contemporaneous written acknowledgement. The date was an issue, but they definitely did not satisfy the delivery rules, the timing there. So we had mentioned July 13th, Fidelity Charitable actually received the stock certificate. The court determined that. July 14th, 2015, the contribution and stock purchase agreement was revised to state the petitioner contributed shares to Fidelity Charitable on July 10th, 2015, and on July 15th, 2015. So, you know, a lot of back and forth with dates, fact pattern here that really didn't help the taxpayer. We had mentioned, so Fidelity Charitable received $2,941,966 in cash proceeds, and the deduction they took or tried to take was north of 3 million. I think it was what, 3.2 million, something like that. So
something,
so pretty bold move there on part of the taxpayer. On November 18th, 2015, Fidelity Charitable sent the petitioner a receipt acknowledging a charitable contribution of the shares. And that receipt had the June 11th, 2015 gift date. So, you know, I'm sure, you know, I think everyone feels pressure in these types of transactions, but you really have to be disciplined and pay attention to these rules. Don't take them lightly. The service doesn't take it lightly if you stray from these qualified appraisal regulations. And I've seen this many times with charitable gifts. Taxpayers don't want to pay that appraisal fee. They do not want to adhere to the formalities. They don't really appreciate and recognize the seriousness of following those qualified appraisal regulations to the T. And when the petitioner filed his return here, of course, he didn't report any capital gains. And I have it here in my notes that the deduction they claimed was $3,282,511. So you don't report the gain. You claim a deduction higher than the amount you actually received in the donor advised account. Fact pattern played out too. He didn't even have the donor advised account established until very late in the game when they were ready to make the gift.
Yeah, it was pretty late. Yeah.
And then the service ultimately issued a notice of deficiency for $647,489. They disallowed the charitable income tax deduction. They assessed a penalty of $129,498, and they went after the client or the taxpayer on the accuracy related penalties under 6662. Ultimately, the service did not win on that issue. But again, the deduction was disallowed. The gain was recognized, realized under the anticipatory assignment of income rules. So a really bad result for the taxpayer here.
Yeah, other than I do think the advisors did a good job on getting that penalty, winning on the penalty.
Yeah.
I don't think that was an obvious case where you say the IRS is overstepping its bounds, seeking a penalty here.
Yeah, it was kind of interesting there because they said it was reasonable for the taxpayer to rely upon the advice of their advisor for that accuracy related penalty issue, but it was unreasonable for purposes. I think perhaps it was the charitable deduction for the qualified appraisal issue, the substantial compliance issue.
Yeah, they did not hit reasonable cause for substantial compliance.
Mm-hmm.
Yeah.
So in an interesting ruling there, and the court got it right here, in my opinion. I mean, they really focused on the issue that this was a virtual certainty that this gift was going to take place, or this sale was going to take place, and was fixed. The sale was fixed before the gift. They talk about some of the actions that occurred leading up to the sale, where there was a cash sweep. They paid out bonuses and took $10 million out of the corporation right before the closing. And so the court looked at those facts and said, there's no turning back here. This is going to happen. The gain has ripened. It's fixed. The taxpayer is going to have to pay, and you cannot claim that you're going to be able to bypass that gain by giving it that late in the game. A lot of good case law here, a lot of good, the cases that John, you and I studied back in our LLM courses, Lucas v. Earl, Hellring v. Horst, a lot of great fundamental tax law cases there that touch on all these issues. I think this is a great read for advisors to look through this opinion. It's a 40-page opinion, but there's a lot of good information in there. They spell out the qualified appraisal requirements in great detail. It's interesting, the fact pattern played out here. It was Fidelity Charitable that brought up the anticipatory assignment of income issue, and good for them. Trying to help the taxpayer there. One thing I thought about as I read this too, and you can see how this would play out as a practitioner advising clients, the attorney in the case, and I think when dealing with clients that are entrepreneurs and business people, you have to be very specific, very specific.
Yes.
And the language that was used, and it was on April 21st, 2015, the attorney responded to the petitioner and said the deadline to assign the stock to a donor advised fund is prior to the execution of the definitive purchase agreement. So you have to think, we think like lawyers, and we think, okay, you got to put a lot of time in between the gift and the ultimate sale. Like we said, get it in. Maybe get it in before the LOI, get it in before the shareholder and directors vote.
Yeah.
Get that done, then you do the sale. Well, if you tell a businessman, a businesswoman, get it done before there's a definitive purchase agreement, they're gonna take that information and they're gonna think something else. They're gonna think, okay, closing, right? That's the definitive purchase agreement. They're not gonna think shareholder vote. Maybe they would, but I think you have to be clear. And this case is a good lesson for all of us. You have to be clear with your clients. You have to be pretty firm because, like we said, the personalities of these clients, they get things done. They're the CEO. Yeah. They expect things to get done. And they expect them to get done the way they want them to get done. But we have to really, really push. And it can be awkward for us as advisors.
Absolutely. And I think we have to bear in mind that we deal with a lot of things where it takes more than one time explaining them for it to not just sound like a bunch of gobbledygook. I mean, if you think about the first time you explained to a client who hasn't done planning before, the first time they hear about crummy letters, they're like, how could that possibly be sufficient to qualify this as a gift of a present interest when the absence of the letter might not qualify? It seems like gobbledygook to clients. It seems like it's just a bunch of legalese that somebody made up because they didn't have anything better to do. Yeah. And I think it's the same way with this, like, you write this email, you think you're being firm with your client. You're saying once there's a definitive agreement to purchase, you may think you're being very clear, like, okay, you sign that maybe you think you're saying once you sign that LOI or once you shake that hand, maybe you're thinking way further back in the timeline, but the client, they may be mixing that statement up with the time that they were explained how crummy letters worked, or the time that they were explained how an intentionally defective grantor trust works. And they're like, wait a minute, it's not mine, but it is mine. It's not mine under estate tax purposes. It is mine under income tax purposes. This is just, lawyers just make stuff up. Yeah. And I deal in facts. I deal in the real world. That's why you guys are just an obstacle. And I think we have to keep in mind that to us, it all makes sense that some formalities are just formalities and they're enforceable. And sometimes it's a little more facts and circumstances, and we can separate that all in our heads very well because it's what we deal in every day. But you got to remember what it sounds like you say, this is somebody who's just used to getting things done. He heard that, he interpreted that to mean, final sale agreement. Yeah. And you read these cases and you can see how it would play out. And another good thing I think for us as tax and estate planning professionals, practitioners, is to make sure that we emphasize the importance of these rules to our colleagues, the ones who are doing the merger deal, the corporate attorneys, and that communication. And sometimes there can be a gap in communication because you know how these deals are. There's a million parts to them. Yeah. They tend to happen very quickly. And when they ramp up quickly. Yeah. Sometimes they can fall through at the last minute. But when you're working on a deal, you may not, as a corporate attorney, be so much zeroed in on what we see, right, in terms of the tax implications of not getting the steps in the proper place. So I think it's important for us to be firm with our colleagues as well, who don't deal in this area, and to really stress the importance of corporate formalities, of timing of the gift, of adhering to these regulations, making sure that they understand the importance of it, maybe even
Show them what the consequences will be if you don't follow this from a tax standpoint. Very bad result here for the taxpayer. And, after the fact, I'm sure they're probably thinking, well, what happened here? I thought we had it all figured out. And you got to really emphasize the importance of sticking to the formalities. The other thing here, again, I touched on and we discussed, is the communication. And you see, and I've seen these emails where you have financial advisors on the email chain, you have the corporate attorneys, you have the accountants, you have representatives from the charity. And so, maybe just pick up the phone and call your client, and don't feel that push to respond immediately to an email chain with 20 people on it. You look at this and the language of these emails. There's an email in here where the petitioner writes, Ann and I have agreed that we want to put 3.5 million in the fund, but I would rather wait as long as possible to pull the trigger. If we do it and the sale does not go through, I guess my brothers could own more stock than I, and I am not sure if it could be reversed. I have not definitively given Richard a number. Please know this and help us plan accordingly. So, a tough task there for the attorney, right? The client wants one thing, they expect one thing, they don't appreciate these formalities. And then you have that in writing. You have that not only in writing, you have that in the tax court opinion. From the language. So,
and it's very clear. I mean, he does, I think that's the other thing, you talk about understanding how your client's going to view your communications. I think you look at this and you say, hey, here's somebody who, if I'm not careful, he might just interpret everything I say in term to, you can actually wait till this deal is a certainty to assign these things to charity, because that's what you really want. He's told his clients that's what he really wants. And we don't know what the attorney said on the phone. We're not trying to say, sure, we know exactly what happened in this case. We know what the court opinion says, and we know what it's like to talk to clients. And
there's a lot of pressure.
There's a lot of pressure, but you got to take the client's cues. And I'm not saying they didn't, but I think it's a good reminder here that your client very well may. I think if you get this email from your client or a similar email from your client, what he's saying is, if you don't push me to follow, to really follow the formalities here and get this transfer done, I am not going to do it until I basically already signed away the company. And I'm gonna sign the stock certificate, and then I'm gonna sign the sale agreement 2 seconds later. And you have to interpret that and say, oh, wait a minute, we've got a guy who's gonna give himself a headache potentially, because what he really wants is very clear in that email, and you have to coach him against it. We are an obstacle as an attorney. I remember when I was in law school, with this New York attorney come out to our law school and talk about what it's like to practice law in New York. And he said, you're sitting at the end of this big board table, you're the lowest paid person in the room, and everyone else works everything else out, and then they look down at the end of the table, and you guys are shaking your head no, and so everyone hates you. But sometimes we have to tell clients, look, I say no, I cause problems for you now to avoid bigger problems later.
Well, attorneys are risk averse.
We're helping manage the risk. That nobody wants to even think about the risk. We go into business to get rich. We don't go into business to think about how bad it's going to be.
And they're willing to take calculated risks, and that's why they're entrepreneurs, and that's why they're successful. But absolutely. But in this case, the IRS is not going to be your friend if you're going to be this loose with the rules and the steps in place.
And it doesn't hurt to remind your clients, look, gift tax returns and estate tax returns are not income tax returns. We all hear jokes occasionally from CPAs about how rarely things get audited, or, I've done this for 25 years. I've only ever seen an audit once, or, people use that as a justification to not do some extra little step. You occasionally you hear of that, or you hear of someone else doing that. We need to remind our clients, they may be hearing those jokes too. Gift tax returns do get audited. Estate tax returns do get audited. It's not like fiduciary income tax returns where you can sit in a room of CPAs and say, has anyone ever had their 1041 audited? And you'll see a bunch of people say no.
Yeah.
If you're preparing estate and gift tax returns, you're aware of audits. You have had your clients get audited.
Yeah.
It's not a sign that somebody messed something up. It's just something the IRS does.
Yeah.
And we have to remind our clients of that as well if we think they're going to push the limits.
Yeah, it absolutely. Jon, just kind of in conclusion here, and we touched on all these issues, but I also wanted to mention your firm. You do a lot of training for attorneys as well, I believe.
Attorneys and accountants.
Forum, yeah. Is that for attorneys and accountants? And
yeah.
So
that's a lot of free webinars, and we do some paid for seminars on the train on flow through. Yeah.
Which you're known for that. And that's in addition to Hackerling and Notre Dame, some of these great conferences we all attend, your firm is known for really teaching practitioners on the flow through entities, pass through accounting, partnership tax, and those really thorny corporate tax issues. So do you actually teach at those courses? As Chuck Levun is I know.
I have not done any of the actual live teaching. I write some of the materials. Chuck Lev and Michael, they do the actual live speaking, and sometimes on the webinars somebody else joins in. Or sometimes they'll invite a special guest. Had various special guests through the years, but yeah, Chuck and Michael do a lot of the presenting. Usually they do all of it, and it's important. These things come up. I'm sure they'll be touching on Hohenscheid and the Cecil was another interesting valuation case. Now we don't do, none of us are appraisers. We're not really trying to train people on, how on the appraisal thing. Obviously, when you have the regulations on what makes someone a qualified appraiser and what makes a qualified appraisal. We're not, I don't think you ever want to approach these things and say, well, we've got substantial compliance with the appraisal regulations. I mean, obviously you want to hope for that. If you look back at a gift tax return and you say, oh, this appraisal doesn't actually say that it's being prepared to value a gift that was made. You want to say, well, we did everything else right, so I don't think it's going to be a problem. But it's good. There's a very simple. It's not that many things that are absolutely required in the regulations for a qualified appraisal. It is worth your time, and it's worth your client's money to go through and say, are all of these things on this regulation checked off on the list? When I review gift tax returns, I find half the time that one of those things is missing from an appraisal, and sometimes it's a really small thing like not saying the date of the gift, but as you see in this opinion, the IRS made a big deal out of the date of the gift not being on.
And it was huge in this case because it did impact the valuation was impacted by that. But they go to list, and you think about what they did wrong here. The date was wrong. They didn't list the qualifications of the appraiser. The appraiser was not a qualified appraiser. The court determined that. They did not have a statement saying it was prepared for income tax purposes. The methodology was incorrect. So they really botched it. It wasn't close. And I think if you're at a trial and you're trying to rely on substantial compliance and you've missed those issues in the appraisal, it's an uphill battle. You're not going to win that. And they did not win that. And so a good lesson, I think, is an unfortunate lesson for the taxpayer here, but important again. And this is going to be talked about, and we could show this to clients. You know, if you don't do what you're supposed to do, is it really worth it not paying that extra money to get the CPA firm to do the qualified appraisal?
And the answer is no. We're talking about a $3 million deduction here.
Yeah.
In the biggest, probably the biggest income tax year of the client's life.
Yeah.
It's not worth it.
No, but you know, we've seen it. It's human nature, and I think we've touched on it. It's
but sometimes nobody likes writing those checks. I certainly don't blame them. But you know, and it's another, you know, one of the other little side takeaways here is, you know, we all want to be cost conscious, and we all sometimes get annoyed at, you know, when you're in one of these big transactions with multiple professionals, you can get annoyed at if you see what another professional is charging or making off of a deal. But what you want to remember is maybe we think, you know, oh, that sole appraisal is almost as much or more than what the estate planning attorneys are making, or than what someone else is making on the deal. We don't want to think that way. Because we don't want to let that bleed over into our client. You know, we don't want to let our distaste over what someone else is charging affect our client's willingness to get good advice. I mean, you know,
well, you can see it from the client's perspective too. You're thinking in your mind, I've already paid these people all of this money. They're just trying to get me to pay a little bit more money, you know, and that's probably going through the mind of the client. It's just another fee they're trying to lob on in this deal. But certainly,
and I'm not talking about colluding with other parties to get more money, but what I'm saying is,
I'm not suggesting.
Oh yeah, I know you. I know you understand.
You could understand the client's perspective here, saying, "Oh, this is just another," you know. And as a businessman, oh, we cut that, we cut this. Let's trim the fat. This is not fat you want to trim, and I'm not to suggest it's fat, but you certainly don't want to get cheap on this matter.
You know, Chuck Levun tells me all the time, when you're involved in one of these deals, if you can find a way to help the other professionals in the deal look good, your client's going to be better served, and the outcome is going to be better. It may take a little bit of effort, maybe sometime, you know, maybe you call someone before you write an email to that you know, reply all. You know, maybe you give someone else the opportunity to raise an issue that you identify, because it just looks better coming from them. But you know, I mean, you know, if you're reviewing the accountant's work or whoever's work, and you see a typo, you can look like you're smarter than they are by pointing out to everyone that you found the typo, but you can also damage your client's trust of that other professional who just honestly, all they did was make a typo. So you can call them and say, hey, I saw this on page 15, you know, and that kind of thing. And we don't know what went on in this case, like I said before, but you never know if that's the kind of behavior that makes people cut corners and think, you know, well, if my attorney has seen, you know, 100 appraisals before, she can coach this guy through, you know, the gift appraisal, the charitable deduction appraisal, even though he maybe doesn't have all the qualifications. We don't know if there was a conversation like that or not, but you know, we always want to try to make the professionals involved look good. We always want to be a team together, because that's what you are for your clients anyway. You know, but one thing appraisals, all of this, it's all part of presenting a strong front. And, you know, I don't know what percentage of IRS agents assume that every taxpayer is a bad person. It's not 0%. It's not 100% for sure. But you present this strong front. You provide an appraisal that makes sense, that looks like it's done intentionally and by a qualified person, and it helps them be at ease that, oh, this isn't one of those taxpayers.
Yeah.
And
Well, I'm sure that
instead-
the agent, the examiner's got a checklist. They probably go through that checklist. And in this case, some pretty basic things were missed in that appraisal. And so
yeah,
that wasn't a really difficult call for the court.
yeah, there was some low-hanging fruit here, for the IRS, and that's what we want to avoid. And
Yeah, the case, just to touch back for of what constitutes a valid gift in Michigan. I did want to point this out since this is a Michigan case. Davidson v. Bugbee.
yeah,
And what constitutes a valid gift in Michigan? There has to be donor intent to make the gift, actual or constructive delivery of the subject matter of the gift. They hear the stock certificate, and then donee acceptance. So kind of some basic law school type information there, but important, right? And you can't hold on to it. You can't be slow to pull the trigger like the donor taxpayer did here. You have to make that irrevocable surrender of title, dominion, and control. I'm sure Fidelity was in an awkward position here. They would not sign off on some of the closing documents until they got that certificate, and good for them. They stuck to their guns there, and you have protocols in place for a reason, and certainly they were correct in that instance, that you need that delivery, you need the delivery, you need the acceptance.
He should have just convinced his brothers, we all need this deduction. Let's all give the same amount to charity. We'll all have, not that might not have been an option, but you try to think about, okay, what could he have done to avoid this whole scenario? One thing would have been pitch to the brothers, hey, my advisor gave me a tip here that I'm thinking about. What do you think of this? If we put 3 million in each, we get we don't recognize the sale income, and we get the deduction. Obviously there were lots of things. We pointed out many things that could have been done a little differently, but well,
that gets to donor intent too.
Yeah.
What is his intent? If his intent is indeed charitable, that he's going to make the gift, regardless of whether the deal goes through or the deal doesn't go through, he's going to make the gift. And so I think that's the kind of fact pattern that the service and the court is looking at. Certainly, there are tax reasons for making a gift. He didn't get them here because he really, that charitable intent wasn't there from the get-go. I mean, certainly he wants to benefit charity, but the tax motivation seemed to be more of the reasoning here for the taxpayer. So just get the timing right, make that gift, then you work on selling the company through the transaction, and
get out in front of it.
but just a bad fact pattern here for the taxpayer. A hard lesson learned, but great case. Like I said, tax attorneys, accountants, appraisers are going to be turning this case and pointing to it. It'll be talked about for years to come because of the important rules at play here. So, John, I want to thank you for your time. I won't keep you any longer, but I appreciate your commentary and expertise, and it's always good to be able to discuss matters with you and go over cases like this.
Yeah, good to see you. There's still plenty, as we've discussed, there's still plenty of opportunity to access, to avoid income if you're going to sell the company down.
Oh, certainly.
This is not a symbol of any avenue for tax savings being dead. It's just an illustration of there are lines and that you have to abide by in order to access these deductions. And not that we said anything to the contrary, but
no, I agree with you. I think there's plenty of opportunity, prior to a transaction, for charitable tax planning. And in many cases, after the transaction, with the proceeds after the transaction occurs. So, but if you want to bypass that gain, you certainly can't wait this long. It's gonna be a problem for you. You're gonna run into this issue. So, well, great, John. Thank you, and we'll conclude here. I think we've gone over quite a bit here, and quite a bit to learn from this case. We appreciate your time. Thank you.
Hey, have a good one.
Take care.